Now, let me kind of explain how the rest of today's going to go, especially for the first part of today, especially through about the end of right up to lunch. We're going to be building a foundation, right? I kind of have to start from the very ground up. So we're going to talk about some very basic insurance concepts here real quick, but we're going to slowly but surely kind of build on this foundation and try and make sure you understand how property insurance works, right? We're going to also address liability, which are also known as casualty policies here in just a little bit, but we're going to put a big focus on property today. All right, we'll talk a lot more about liability tomorrow when we talk about commercial, business policies, things like that. But what we want to do right now is we want to just build a really solid foundation with property insurance. So everyone's on page 1.1. I will once again encourage you to take notes, underlines, highlights, things like that, especially as I work my way through this book. So property insurance basics. Property insurance is coverage that protects you. So this is what we're doing here. We're protecting you if your property is damaged by a covered peril. What is it covering? Buildings and contents. Please underline that phrase right there, because sometimes when it comes to property insurance, people think that that includes your car. It 100% does not. Right? We're going to actually talk about tomorrow how you actually have to have your own policy called an auto policy, right, in order to cover your vehicle. So we're talking about how you're going to cover your stuff and how you're going to cover your buildings, houses, commercial buildings, things like that are all described as your property. Okay, so that's what we're going to be focusing on now. Property insurance is a two-party contract. Only you, right, the insured, and your insurance company, which is the insurer, okay? So the insured suffers a covered loss. That means a loss caused by a covered peril. The insurance company will reimburse the insured for that loss. Why? Because insurance contracts are contracts of what? Indemnity, right? That describes indemnity, does it not? Right? It reimburses you for the amount of that loss, but only up to a limit that was stated on your deck page. So there's a couple of things we need to unpack here. What is your limit? The limit, guys, is how much your insurance company is going to pay up until, no matter how much your property is worth, right? So say I have a $100,000 house, but I only insure it for $40,000. What is the insurance company going to pay me if it gets damaged? $40,000, right? It only pays up to the limit. Right now, what I decide to insure my property for, though, is that specific to only me, or is that specific to everyone else? It's just me, isn't it? So here's the idea. Any item that's stated on your deck page, your declarations page, has to be specific to only you. Okay, you're going to get questions on this exam about what has to show up on the deck page and what has to show up in the policy itself. Guys, policies, one to the other, are very similar. Right? There's not a lot of differences one policy to the other. What is specific, though, is everything that shows up on the deck page. Who is being insured? What is being insured? How much it's being insured for? How much you're paying for it, and how often. Right? These are all things that show up on your deck page because it's personalizing your policy. In fact, that's why I want you to write here, is your deck page personalizes your policy. Anything that's specific to that one contract has to be on your deck page. In other words, the second party becomes liable to the first because the loss is covered by the contract. And this phrase right here, this sentence, describes a vocab term you will need to know. It's called contractual liability. Contractual liability basically states this: because I'm under contract with an insurance company, if I suffer a covered loss, are they obligated to me? Are they liable to me to pay that loss?
Yes.
Yes, they are. Unless they can find a reason to deny the claim because something happened or it happened as the result of an exclusion, right? But more often than not, they have to pay for that. Why? Because they are under contract. That's why we call it contractual liability. And this is a two-word phrase. We're going to see a lot more, okay? So you have to know that. Now, property insurance will be divided up into two major categories. Either you're going to insure it under a named peril policy, which means that you're going to choose a form that's going to list out every single peril you could be covered from. See, if it's not named as a covered peril, if it's not listed, that's another name we're going to use, or another word we're going to use today. If it's not scheduled as a named peril, it won't be covered. Right? It's very restrictive. Right? If my home is destroyed by a fire, but fire is not listed as a named peril, would that loss be covered? No. Right? So we have to understand it's a very restrictive policy. That's what named peril is. Or we can choose this coverage right here. This is called special peril coverage, or we have two other words that we use for this, and your test will use both of these phrases, so you've got to be prepared for both of them. The first one is called all risk, and the other phrase is called open peril. But that's very deceptive, because it might lead you to believe that every single risk, every single peril is covered here. That is not necessarily true. Because there could be things that could happen to your property that won't be covered. Why? Not because they're not a named peril, but because the insurance company has actually specified that as a reason that they won't pay a claim. And that is the word exclusion. So I want you to write that word down here. This is a named peril policy. This will be a named exclusion policy. And we're going to break down these in much more detail. I'm just going to, like I said, giving you a very quick foundation here. But as we continue to move forward, we need to talk about what a named peril policy is first. And there's two different categories. And you need to know both of them. They're notified here underneath basic and broad. But we're going to break down basic coverage here first. See, the most simplistic kind of coverage you can get in the United States for your property is called basic. It doesn't get any worse. No one can buy property insurance and get any worse than this coverage right here. This is the most simplistic, most cheapest coverage you can get. It starts off with fire coverage. In fact, fire was actually the very first insurance anyone could ever buy in the United States. Okay? Lloyd's of London was the very first company that ever sold a policy in the United States, and it said that if your property was damaged because of fire, and there were 3 perils underneath fire, that they would cover it. But anything else that happened to it, it wouldn't. Okay? So let's look at these 3 perils real quick. If the fire that damages your property was unfriendly or hostile, that just meant a fire where it wasn't supposed to be, okay? All right, a log rolls out of your fireplace, then obviously that log's not where it's supposed to be, and it causes fire, of course, then that is a unfriendly or hostile fire. And then all related damage. Let me ask you this, if a fireman comes out to your home to put out a fire, is there a chance that fireman could actually do more damage to your home in order to put out that fire?
Yes.
Of course there is. I mean, the water damage alone could be a lot worse, right? But then also, this happened in the house right across the street from me. Didn't even know that house was on fire until I heard the breaking of windows, right? That's what they were doing. They were breaking windows and they were trying to vent smoke. If they have to bust down doors or anything like that. All of that damage is related to the fire, right? So of course that will all be covered here. Lightning damage is also covered here underneath fire. And the reason why is because most homes back when the United States was first in its early days were made out of what material? Wood. What happens to wood when it gets struck by lightning?
Burn.
Oh yeah, right? It either burns or in some cases it actually causes that wood to expand or contract, right? Could actually make that home explode in some cases. So any damage caused by lightning to your property now is also going to be covered under fire, and then any kind of explosion that happens within the home. All right? All 3 of these are all covered underneath fire. That was the most simplistic coverage anyone could buy until they were like, yeah, we need to add in a few more perils that's really restrictive, right? So they added in what they call the extended coverage endorsement. Please know this phrase because this is how we make up the basic form here. We take fire and we add in the extended coverage endorsement. We add in a bunch more perils here that will now be covered underneath the most simplistic type of coverage that you could ever have. You need to know every single one of these perils. So we're going to break them down here real quick. We signify them by the acronym WARVs, because there's 2 V's, not 1. Okay, so if you hear me say WARVs, now you know why. But we're going to break this down. W stands for wind. Any damage done to your property because of wind damage, hurricane damage, straight line winds, tornadoes, right? Any of that damage that now happens to your property is now covered underneath a basic form. Okay, so wind damage is now automatically covered. H is hail. Any damage done to your property because of hail. Now I know most cases, sometimes when hail damages our property, it's not only our homes, but it's our cars that get damaged as well. Yeah, that's not what we're talking about here. We're just talking about our property, okay? So hail damages your roof, hail damages your siding, hailstone comes in and knocks out a window, right? All of that can be covered underneath hail damage. The next one, aircraft, missiles, and spacecraft. Now, I know that sounds kind of intense, but aircraft and spacecraft is talking about any item that could fall off of the craft, right? They actually had to add in spacecraft out after the space race in Houston because when those rockets were being launched into space, we've all seen the recordings of it, right? When the rockets go up, what comes down? All the debris, right, around that rocket. And whenever that debris fell, sometimes it was falling on homes inside of Houston, in the Houston area. And of course, that's not their fault, so they had to add in spacecraft. But any item or any type of part of the craft that were to hit your property is now covered. Now, when you see this word missile, though, this may not be what you're thinking. This is not talking about a ballistic military missile. A missile in this definition is any item that is being projected toward your home. And the example that I want to use here is like a baseball. Right? If a baseball is hit and it hits your property, damages a window, damages your house, that is determined to be a missile. Why? Because it was projected toward your home. Okay? Ballistic missiles, that's not what we're talking about here. We're talking about any item being projected toward your home. The R stands for riot, riot attending strike, and civil commotion. We've seen way too much of this on the news lately, haven't we? I mean, Ferguson, Baltimore, Milwaukee, Carolina, you name it. Trump's inauguration. I mean, anytime that you've seen any item, though, that any type of riot that's happened on the news, rest assured that if that property owner had at least some type of property coverage, that was covered. Thank goodness.
Yeah.
Right? So all of that damage is covered if they have some kind of property damage. Now, let me be very clear, though. Sometimes riots or civil commotions can escalate. And we saw this happen in Turkey over last summer when there was actually an attempt to overthrow the government, right? Now, if that ever happened here in the United States, that's not covered underneath this. Why? Because an attempt to overthrow the government is actually considered to be an act of what?
War.
War. If you want to know one of the easiest exclusions on this test, it's war, right? So this isn't an act of war here, though. That's just a riot, and any damage caused by a riot would definitely be covered. The first V is vehicle damage. Now, once again, we're not talking about damage to your vehicle, though, right? We're not talking about damage to your vehicle. We're talking about damage that your vehicle causes to your property, or a vehicle causes to your property. Remember how I said a truck could come barreling through this wall right here? Yeah, that would be vehicle damage. My grandparents live off of a highway in Racine, Wisconsin. Twice, not once, but twice, cars have come careening off of that highway and hit their front porch.
Good golly.
That's called vehicle damage. Thank God they weren't on said porch when it was hit, but right, that happens, right? When cars come off the highway or cause any kind of property damage, right? That would be vehicle damage. Also, the next V, not one we have to worry about here in Kansas too much, but it's volcanic eruption. Now, any damage associated with the eruption itself is what's being covered here. So do me a favor and underline that word erupt, right? So it's covering the blast, right? It's covering ash, right? We've seen movies like Dante's Peak or Volcano, right, where that ash comes flying down and almost looks like rain, almost, okay? And then, of course, the lava. Okay, so all three of those are all covered by volcanic eruption, but there's another event that happens along with volcanic eruption that wouldn't be covered here, and that, of course, is the earthquake. See, earthquake damage is not covered under volcanic eruption. It has to be associated with the eruption itself, okay? And the E, external explosion. Any explosion that happened inside the house, covered here. Now any explosion that happens outside of the house that hurts your property can now be covered underneath basic coverage. And the last one here, smoke. S is for smoke from a vented heating or cooking unit. But as you're looking at this list here, would you agree with me that there's a lot more things that could happen to our property other than this small little list right here?
Oh, yeah.
Oh, yeah. Right, so we understand that this is a good start, right? But there's a lot more things that can happen. But if I only have basic coverage, remember, it's only going to cover these perils right here. It won't cover anything else. Remember, if it's named, it's covered. If it's not named, it's not covered. Everyone clear on that?
Mm-hmm.
Okay, so that's basic coverage. Then we decided to add in a few more. So here's what we did. We took fire plus the extended coverage endorsement, also known as WARVs, and then we move it over to broad. The very first thing you need to understand about broad is it's basic. Okay, so you're moving everything over first. You don't lose anything in the transfer. But then you add in a few extra perils down here. So we're going to break down each one of these real quick. I don't have a fancy acronym for this one. Can't find one. If you can help me with one, I'm all ears. All right, the first one is vandalism and malicious mischief. So if your property, your home is vandalized, or kids were just messing around and caused damage, which is what malicious mischief is, Was that covered underneath the basic form? No. But if I have the broad form, that is a named peril and it will now be covered. Okay? So vandalism and malicious mischief is added in under broad. Weight of ice, snow, and sleet. Especially in communities where ice, snow, and sleet happen a lot, like in communities up north. That's why you see a lot of those roofs shaped like this. Because it allows that ice, snow, and sleet to get off of those roofs a lot quicker. Okay, because if that precipitation sits on property long enough, that can cause a lot of damage, right? We saw that happen in Minnesota, right, where the snow just made the entire Metrodome roof just come caving in. Okay, so that absolutely could hurt your property. Falling objects is another one. And I know that sounds really kind of random, but that's pretty much what it is. It's any random object that could fall from the sky and hit your property. Now, someone has asked me a very specific question, does it include drones? I don't know, but according to this test, drones don't exist, right? Because quite literally, this test is the one that was given 40 years ago when drones were just something that was in a sci-fi movie, okay? So here's what you need to understand, though, about falling objects. It's any item that could randomly hit your home. Now, this is a dead-on true story. There was a gentleman who was sitting in his living room, heard a crash in his den, went back to his den, looked up and saw a big hole in his roof, looked down in his floor, and there was this big blue ball just sitting right in the middle of his den floor, and it stunk to high heaven. He had no idea what this was. He did a lot of research. Turned out that he got a hold of the FAA, and a passenger airliner had been flying overhead higher than it should have when it flushed its toilet. What do you think happened to that when it flushed its toilet? It froze into a big blue ball, quite literally, of crap, and it fell right in the middle of this guy's house. Yeah. So you want an example of a falling object? A gross one, but it's true, then that's an example. Okay?
Wow.
So, yeah, F. Yeah, I'm sure he said something like that. Number 15, that's good. Accidental discharge of appliance or plumbing. What you need to understand here, though, is it's only going to cover the damage that it causes. It's not going to cover the piece of the plumbing or the appliance itself, right? Because we all have refrigerators, right, that have maybe a little pipe that goes to it that provides us ice or water, right, out of a spigot. And here's what would happen. If that hose gets like damaged to the point where it gets pinched off or it gets cut accidentally and it causes damage to the appliance itself, do insurance companies cover appliances? No, they can't, right? So the damage isn't covered by your insurance to the actual appliance, but let's say that water damages your floor, damages your cabinet, damages anything else around it, would that all be covered? Yes, okay. So here, once again, the key is it's gonna not cover the appliance or the piece of plumbing itself, but it'll cover the damage, all right? Even if they make you go down to Home Depot and buy another $6 pipe and they cover $1,500 damage, they'll still make you do that. Okay, so they don't cover the appliance or the piece of plumbing, but they cover everything else. Freezing of pipes, right? If your pipes freeze, that could definitely cause some damage to your property. Now, there's a little stipulation that goes along with this, though. If your pipes freeze and the insurance company can prove that you didn't maintain enough adequate heat to your property, will they actually cover that loss? No. Because that's actually going to be defined as an intentional act, right? You intentionally turned off your heat, and therefore that's what caused your pipes to freeze, and they won't cover that, okay? So underneath freezing of pipes, just write in that little phrase, as long as you maintain enough adequate heat. Sudden and accidental tearing apart of heating, air conditioner, or water heater. That's not one that you see a lot anymore because those kind of appliances don't do that anymore. But back when they originally were being made, they did. And that kind of damage could actually hurt your property. So they had to add in this one. And the last one is damage by artificially generated electricity. If a power surge were to hit your home, could that cause damage to your property?
Oh, yeah.
Oh, gosh, yeah. Right? Now, of course, the only thing that's not covered here, though, is electronics themselves. That's why they want you plugging your stuff into like power surge protectors, right? Which I've heard sometimes work and sometimes don't. But of course, electronics aren't covered by insurance companies anyway, okay? So, but any other damage that the power surge could cause to your home will now be covered here. But we also have to be very clear, on this entire page, these are both named peril policies. So the perils had to be named in order for them to be what? Covered. That's about as simple as it gets, guys. You've got to know this. Commit this little phrase to memory if you haven't already. Any questions on named peril policies? There's only two of them, okay? Basic and broad. But is it important for you to know these perils? It is. Because you don't want there to be a question on this test and they ask, such and such happened, right? There was damage in a public riot, or there was damage because a car hit a house. Is that going to be covered by a basic form? You need to know this stuff, okay? All right, so those are named peril policies. This right here, the special peril or the all risk or the open peril, are the only other form that you need to know when it comes to property insurance. I can either choose a named peril policy, or I can choose this policy right here, which doesn't name the perils that are covered. It names the perils that are what? Not covered. Right? A special form names the perils that aren't covered. So remember how I said the basic and the broad form were named peril policies? I would tell you that the special peril form is a named exclusion policy. They are naming the things that aren't covered. You want to know what's covered underneath special? It's everything under basic, it's everything underneath broad, and it's anything else that you can think of, as long as it's not one of these in here. Okay? So think about this. Under a basic or a broad named peril coverage, who has the burden of proof?
The insured.
The insured has the burden of proof, right? Because the insured has to prove that it happened as the result of a named peril in order for it to be covered, right? But underneath a special peril coverage form, who has the burden of proof? The insurance company does. Because now, remember, they are contractually liable to the client to pay for any loss unless they can prove it happened as a result of one of these. So is this list here just as important? Oh, you betcha. Okay, so we're going to go through some of the most common exclusions out there. The first one is freezing of plumbing. Wait a minute, Andrew, I thought you said that was already covered. It is, but remember, if you made no effort to control your heat, could they deny that claim?
Sure.
Absolutely they could. Right, so that's the first exclusion. Freezing of plumbing if you made no effort to control your heat. Freezing damage that happens to your fence, your pavement, or your pools. Can you prevent that? I mean, you could try, right? You can try and put a little tarp over your fence every single night during a freeze, but is that even practical? No. This is outdoor property, guys. Things are gonna happen to it. Okay, so this is only talking about freezing damage, though. We're not talking about any damage, period. But freezing damage to your fence, pavement, and pavements and pools is not covered. Theft in or to a building under construction until it's been finished or occupied. This is not covered, and it's why when you sometimes drive by construction sites, you see cranes with ladders or big boxes lifted in them overnight. It's because that's where they put all of their equipment. They don't want it to get stolen overnight. It wouldn't be covered underneath any other insurance policy. So that's considered to be an exclusion. Vandalism, malicious mischief, and theft. Wait a minute, Andrew, I thought you said that's a broad named peril. It is, but this is a stipulation, guys, and you have got to know this time frame. If your property is vacant for over a specified period of time, and that time frame is 60 days. So you got to know this. If you haven't already, underline, highlight that, whatever you got to do. But if your property is vacant for 60 days or more, if it's been vandalized, if it gets damaged by malicious mischief, or someone who was trying to break in, they don't know anything's not in there, right? Then all three of those perils are now not covered. That is actually considered to be an exclusion. Now, if your property was vandalized and it was vacant for less than 60 days, is that still covered? Yeah, as long as you had the broad form, right? If you had basic, it wouldn't. But if you had the broad form, that should have been covered. But at no point underneath any coverage form, basic, broad, or special, if your property is vacant for more than 60 days, would that be covered? Okay, so got to know that time frame. Remember I told you, time frames are very, very specific to this test. Excuse me, if your property has any wear, tear, deterioration, or defects, those things happen once again over time, don't they? Right? You can't prevent that. No one can prevent that. No insurance company is going to cover you for losses caused by that stuff. Okay? Same thing with inherent vice or mechanical breakdown. Inherent vice is just the process by which stuff naturally breaks down over time. And mechanical breakdown, that's why you can't buy insurance on any type of machinery breaking down. Now, can you buy a specific type of contract to help you in the event that your piece of machinery does break down? Sure. What do they call those? Warranties. Yeah. But are warranties insurance contracts? No. Some people think they are, guys. They are 100% not. Any damage caused by smog. We don't have to really worry about that here, but man, out in California, if your property is damaged by smog, was that something that happened at one particular time? No, that happened over time, right? Remember how I said if it's not definite in time, place, and amount, you can't cover that. Same way with agricultural smudging or industrial operations, right? Smoke from factories. If it damages your property, insurance companies aren't going to cover that, guys. There's charge of pollutants unless it's caused by a covered peril. Excuse me. So what am I talking about here? Let's say if you have like a barrel of oil in your garage, and then my son is messing around in my garage and he accidentally kicks it over, right? If he accidentally kicks it over while he's playing and it causes damage to my property, could I get covered for that loss? No. That's an exclusion, okay? Even though my son should be a covered peril, he's not, okay? And I'll give you more examples of my son, the covered peril, later on. However, when you're talking about this, when you're talking about caused by a covered peril, if that barrel of oil was in my garage and it gets damaged by a tornado, right? A tornado actually knocks that barrel over and then causes excess damage to my property, could that be covered? Yes, because the discharge was caused by a covered peril. Settling, shrinking, bulging, etc. buildings. This is why cracking of walls can't be covered, guys, is because these are not preventable. Foundations just settle over time. No insurance company will ever cover you for stuff like that. And any damage caused by birds, any damage caused by insects, termite damage, never insurable. Rodents, vermin, or animals owned by or kept by the insured. But is this a massive list? Not really. So if anything happens to my property and it's not a result of one of these, should it be covered if I have the special peril coverage? Yeah, that's why people choose this one, is because there's not a ton of restrictions here. Okay, so the special peril one is the one that's less restrictive, but it's also the one that's definitely out of the three the most what? If it's less restrictive, it's also going to be the most expensive. It's going to cost you more, right? Premiums are going to be more. Basic is going to be the cheapest, right? Because it's the most restrictive out of the three. So once again, if you're trying to understand the parallels between them, that would be why. There are other catastrophic perils that are excluded on all forms. So we're going to break these down. And losses caused by most of these perils in here are just too massive for insurance companies really to cover. But there's some stipulations here, so we'll break them down. The first one is earth movement. Any damage caused by earth movement cannot be covered by any type of insurance policy. Anyone see the movie San Andreas with The Rock a few years ago? Mm-hmm. Yeah, now you know why. Think about those kind of losses. There would be no way an insurance company could cover that. But can you buy an endorsement for your house alone that would cover any earthquake damage? You can. Okay, so you have to add it on by endorsement. What does this word endorsement mean? That means it's something that was added on to your policy. Right? It was something that was not part of the original coverage, but you're adding it on top. Will it affect your premium? Yes. An earthquake endorsement covers, I want you to write this phrase down, shaking damage.
What did you say? Shaking.
Shaking, yes. Shaking damage. Okay, so if anything happens to your home or your property as the result of an earthquake, then if you can prove that it was the result of just the earth shaking, then yes, that can be covered. But there's 3 stipulations here that you have to know when it comes to the earthquake endorsement. Number 1, the coverage typically has a deductible that ranges from 2 to 10% of the amount of coverage. Okay, so you know how sometimes deductibles are based off of like financial amounts? Yeah, not here. It's based off the percentage of the coverage. I've seen it as low as 1, but typically 2 to 10% is what I've seen listed on the test. So that's the phrase I want you to be familiar with. The deductible, though, also applies separately to every single covered structure. See, we're going to talk about homeowners insurance later on this afternoon, and underneath homeowners, you can insure not only your house, but also a shed on your property, right? Or a garage on your property, or a barn on your property. If you had a loss that happened to any single one of those, your deductible would have applied toward all of them. Guess what? If it's a shaking damage claim, you're going to have to pay that deductible to every single covered structure, right? So you owe 10% here, you owe 10% here, you owe 10% here. So that's how the deductibles break down. And then quakes and aftershocks within 72 hours are all actually considered to be part of the same quake, which means they were all the result of a same occurrence, which means that it can all be part of the same claim. Claims are paid out by occurrence, not always by consequence, right? Because, I mean, if there's 2 earthquakes that happen with a 72-hour time frame, maybe one causes a little bit of damage, the other causes a lot. Who cares? The insurance company's like, nope, it's all part of the same claim. Pay your 1 deductible, we'll pay up to the limit, and that's it. Okay. So 3 very big facts when it comes to the earthquake endorsement. But that's something that has to be added onto your policy, and that's only for homeowners insurance. That's not anything that can be bought on a wider basis. Common power failure. When I use that term common, we're talking about something that happens not only to you. This is like a massive power failure, okay? So any type of off-premises power failure, that's way too big of a catastrophic loss to be covered. Water damage, that's a bigger loss that can't be covered. Flood damage, sewer backup, and sump pump failure, all of these are excluded on your coverage unless you add them on by endorsement. So once again, can you endorse flood coverage on your policy? You can. And if this is not looking familiar, the NFIP, buying flood insurance through this plan right here, then you need to put one word right over this box, and it's the word pre-study. It's in there, and you've got to know a little bit about it. It's not a big section. It's like a page of information, I think. But you have to know it. I don't have time to break it down right now, okay? But you do have to know that if you're going to buy flood insurance, you're going to have to endorse it onto your homeowner's policy, and it's bought through the government, through the NFIP, National Flood Insurance Program. Okay. Now, do I know that you can buy flood insurance through other entities now? Yes, I do. But for test purposes, no, you can't. Okay. So once again, I got to tell you, you got to be very socially not thinking, oh, well, that's not 100% true anymore. Who cares? For test purposes, it is. Okay. A couple other ones. Neglect or intentional acts. Because they can actually prove neglect is an intentional act, right? You intentionally left something alone. That's never going to be covered, okay? Anytime you have anything that has to do with nuclear hazards or war, guys, I'm telling you, those are the 2 most common exclusions you're going to see. You see these 2 words being used on the test, immediately think exclusion, right? Think about that. Property damage caused by war, there's no way any insurance company could ever cover for damages from that, okay? Now, this question has come up. It doesn't show up on the test. I don't know the right answer, but I don't know about terrorism. Okay, I know terrorism can be considered to be an act of war. However, for this test, don't worry yourself with that. Okay, so if that question was burning in your head, don't worry about it. For purposes of this test, you don't need to know. Zoning laws and ordinances, safety ordinance. If you ever find yourself in a position where you're underneath a safety ordinance where you've got to actually do some upgrades on your property to make sure you're up to code, yeah, that's not an insurable loss either. And then decisions or failure to decide by a governmental body. When you're looking at everything that's listed here, these all can kind of be classified all in one word, right? These are all exclusions, but these are just ones that cause more massive failure or massive losses. These are just more smaller, possibly, losses, all right? But there's also particular types of property that you cannot insure either, and you have to know some examples of these as well. These are also called exclusions, guys. So an exclusion isn't always necessarily a peril, but it's anything that an insurance company lists that you can't be covered for insurance on, right? So it could be a cause of a loss, but it also could be any property specifically covered by other insurance. That's excluded. If you've got 2 different types of insurance on one piece of property, you cannot expect both of them to pay out at 100%. Now, can you have 2 pieces of insurance or 2 different insurances on the same piece of property? You can. But you can't expect to file a claim on both of them for them both to pay out 100%, right? Because then you'd be double dipping there. You'd be actually getting double payment, and they won't allow you to do that. That's called double indemnity, and you just cannot do that, okay? Aircraft. You cannot buy property insurance on aircraft. You need, ironically enough, aircraft insurance. Same way with vehicles licensed for road use. We'll talk about those policies tomorrow, called auto policies, right? Property in which you have no insurable interest, which meant, once again, you are not in a position of financial loss if anything happened to it. Land, that's a huge one. Guys, if you see any question about you being able to insure land, let me be clear, not property built on land, but land itself. That is not insurable. You can't insure land, okay? Property built on land, absolutely, but not land itself. Damage to animals, birds, fish, and rodents, unless they are inventorying a business. Once again, do I know that there's such a thing called pet insurance out there now? Yes, but for test purposes, it doesn't exist. Okay? Now, can animals be covered? They can if they are considered to be inventory in a business. And we're going to talk about this tomorrow. But I want you to write this phrase up here that we're not going to talk about anymore today, but I want you to have a cross-reference when you're looking at your notes tomorrow night or whenever you're going to be studying out on commercial insurance. Write down this term. It's called business personal property. It's the contents of a business, right? It's inventory and items that they use to run their business. Can you be insured for losses against that stuff? Absolutely. But we're not talking about business today. We get into business tomorrow. But I want to make sure you know it can be. Patios, pavement, etc. Any damage caused to that, unless it's a concrete structure that's an actual building, once again, you can't prevent losses for stuff like that. You can't insure it. And then unrelated tenant's property. If I'm a landlord, and I rent my house out to someone, can I protect that house from loss? Can I insure that house?
Yeah.
Sure I can. Can I protect their property?
No.
Why?
It's not yours.
It's not mine. I can't prove insurable interest, can I?
Right.
Right? I have no insurable interest in that, so I personally can't insure it for them. Guys, a lot of tenants find this out after the fact. They find it out too late. They think that their landlord is actually responsible for insuring their stuff. That is absolutely dead on wrong. Why? Because landlords couldn't protect it even if they wanted to, because they have no insurable interest. Okay? So everything in this list right here, in fact, I would almost argue that everything on this list right here is probably one of the most important things out of the entire 2 days. Because at a lot of points during this test, you're going to be trying to figure out what's covered and what's not. Everything on this list, not. Unless a few of them you can add on by endorsement. So if I could summarize the entire page in one word, it's the word no. Put a big NO right at the top, because that's all these are. These are all exclusions. But as we move forward now, what I want to do is I want to start breaking down the rules, the regulations, the things that actually break down what your rights are inside of an insurance policy. And that's what the term provision means. Okay, so at the top of your page, you don't have a lot of room, but I want you to write this definition right up top here. What a provision does. This is Andrew Kemper's definition. It outlines the rights. Excuse me. It outlines the rights, it outlines the duties, and it outlines the responsibilities of every party in an insurance contract. And how many parties are in a property insurance contract? Two. Who are they?
Insured and the insured.
There you go. Okay. So the insured has rights, the insurance company has rights. And that's what these provisions are now going to do. We're going to start really understanding the meat of these policies. Where do you think provisions show up? Do provisions show up on a deck page? Would it make sense for a provision to show up on a deck page? Is a provision specific only to one contract?
No.
A provision is specific to what? Every single contract. So where a provision is going to be found? In the policy itself, right? Because they're going to outline the rights, duties, and responsibilities of any party in that contract. Now, the context of the provision is going to change. Isn't going to change. The application is. But let's just start breaking them down. So the very first one is policy period. All losses have to occur during the policy period that's stated on your what? Deck page. Why? Because the deck page is specific only to you.
The insured.
See, your policy period is not going to be the same as anyone else's, is it? Okay? So the policy period has to be listed on the deck page, and it's the time frame for which your coverage is in effect. Remember what I said, one of the very first few ways you could actually figure out if a loss was going to be covered, according to our pre-study, was if the loss was definite in what? Time. That's why. Because you have to prove to the insurance company the loss happened while you were insured with them. If I can't do that, the insurance company's not going to say, oh, well, even though it didn't happen on our dime, I guess we'll still pay for it. Of course not. Come on. Right? It has to happen during your policy period. If you can't prove that, that's not going to be a covered loss. Okay? The second thing that also has to happen, though, is not only when the loss took place, but where. And that's what policy territory speaks to. Okay, we're going to use this term policy territory a lot over the next couple days as well. So this is when the loss had to take place. This is where. Now, the policy territory is the area of coverage described in the policy. The territory varies, though, from worldwide down to the specific location, this depending on your contract. We're going to talk about contents, your personal stuff. When we get to the homeowner's policy later on this afternoon, did you know that your stuff is covered worldwide? It doesn't have to be in your home in order to be insured against, losses insured against. You can be halfway around the world and it could still be covered. But of course, your homeowner's insurance, if any damage happens to your home, where did it have to happen? It had to happen on your property, right? So your territory could always vary, and it will vary today and tomorrow. So but if you're going to break it down into one word, it's where, right? This is when the loss had to take place. This is where. Definite in time, definite in place. Okay. All right, now let's break down cancellation and non-renewal. Let me ask you an open-ended question. When an insurance company wants to cancel you out, when do they want you out?
Immediately.
Yeah, as soon as possible,
Yeah.
right? If they want to cancel you, they ain't waiting around. They want you out, okay? But if they want to non-renew you, when do they want you out of your contract? At the end of the policy period, okay? So we've got to know, these are two very, very different words. We've got to know the difference. Cancellation, they want you out now. Non-renewal, they're going to let you continue to the end of your policy period, but after that, you go find insurance somewhere else, okay? So we know now the difference between the two. If the insurance company wants to cancel me out, and there's only one reason why they can cancel me out and give me a specific day's notice for non-payment of premium, I want you to underline this phrase right here. The insurance company must give a minimum of 10 days notice for not paying your premium on time. So remember how we said, if they wanted to cancel you out, they could do so within any reason within that 60 days, right?
Right.
But even if it's during that first 60 days, they come up to you and they say, Mr. Kemper, you didn't pay your premium on time last month, you're gone. Then they only have to give me 10 days notice. Like, that's it. After 10 days, you're done, right? We are canceling you out. 10 days notice for not paying your premium on time. For any other reason, period, right? I went up to them and they said, sorry, you're a Packers fan, we don't like you. They still have to give me 30 days notice for any other reason. 10 days is the only thing that's different, and that's if you didn't pay your premium on time. For any other reason. Now, of course, in that first 60 days, as we already mentioned, the insurance company can cancel me for any reason whatsoever, right? If that reason is for anything other than not paying my premium, they still have to give me 30 days notice. They can't cancel you out right then and there. They have to give you time frame to go find insurance somewhere else, okay? So this 10 and this 30 days has to do with days notice that they're giving you before they're canceling you out. Remember, this 60-day time frame is talking about how many days they have during which they can cancel you for whatever reason. Can they still cancel you after that 60 days? You bet. But for reasons only listed in your what? Policy. Okay. Now, that time frame will change tomorrow. Don't give any attention to this. Don't cross it out, though. Right? We're talking about personal coverages today. This is still applicable, but we'll get back to that tomorrow. So I don't want you to give any credence to that for right now. Okay, so we're talking about cancellation up until this point. Now, from this sentence on, we're talking about non-renewal. The insurance company must give you a minimum of 30 days notice for non-renewal. So remember what non-renewal was. They're going to let you continue to the end of your policy period. They just don't have to renew you. Let me ask you this. Do they ever have to give you a reason for not renewing you? No, they don't. They can just say, hey, sorry, this just isn't working out. Right? At the end of a policy period. They can't cancel you in the middle unless they have a specific reason, unless it's within the first 60 days. But at the end of your policy period, they can come up to you and say, you know what, you had too many claims, you had too many defaults of your premium, we don't like you, whatever reason, they can get rid of you at the end of your policy period. However, they have to give you 30 days notice before they do so. So if my policy period is up on April 1st, they have to notify me by March 1st, right? They gotta give me 30 days notice. Can they come to me on March 15th and say, oh, you know what, Mr. Kemper, we actually decided we're not gonna renew you? No. They're gonna have to keep me now until I give them a reason to cancel me out. So we know the difference between cancellation and non-renewal, right? And now we know some specific time frames. There's a lot of numbers in this paragraph. You need to know them all, okay? There's a lot that's there. Deductible. Standard dollar deductible amount is $250. That's not true. It's actually on property insurance now close to $500 or $1,000, right? But we need to understand what a deductible is. We call it a self-insured retention. Why? Because remember what we're doing if we retain the risk. What are we doing? We're holding on to it, aren't we? Why would anyone retain part of their risk? What's the purpose of a deductible?
For the insurance, so we can pay part of it.
What's that?
So we can pay part of it. for the
Why would we
insurance.
want to hold on to that risk? Why would we want to pay part of that loss on ourselves?
Reduce our premium.
Yeah, we're reducing our premium, aren't we? Because if we go to the insurance company and we're like, hey, we understand we're this much of a risk, but we agree to take that back, right? Retain that back on ourselves. What are they going to do? They're going to be like, oh, well, if you're going to take that back on you, we'll lower your premium, right? Because now their risk is lessened. Okay, so the higher your deductible, the lower your premium. Everyone understands that concept, right? Because the more you take on yourself, the less the insurance company is going to have to take care of for you. But deductibles only come into play on a partial loss. And here's why. Deductibles are deducted from the loss. They're not deducted from the limit. Let's think about that hypothetical situation I threw out just a few minutes ago. I own a $100,000 house, but I chose to insure it for $40,000. In the event of a total loss, which meant that the loss was equal to or greater than my limit, right? And my house is totaled now. How much is the insurance company going to pay out? If my $100,000 house gets totaled by a tornado, how much do they pay out? $40,000. Why? Because that's all I insured it for. See, my loss was $100,000, so the deductible would have been taken from that. But who cares now? This was a total loss. So the insurance company is like, who cares if your $100,000 home got destroyed? You only insured it for 40 grand, so that's all we owe you. Okay? So that's in the event of a total loss. Please underline that phrase though, that in the event of a total loss, your deductible is waived. Deductibles only come into play on total losses. And some deductibles are also expressed as a percentage amount, right? We saw that back on earthquake insurance, didn't we? Right, 2 to 10%. So it doesn't always have to be a financial amount. Other insurance. I know that sounds really vague, but that's literally the name of this provision. What does other insurance mean? That means you have more than one insurance policy covering the same piece of property. Now I told you you could, couldn't you? Right? It was legal for you to have 2 different insurance companies protecting the same piece of property. Can I expect them both to pay 100% of the loss though? No, there's no way. So what can I do though? I can have one pay first and one pay the rest. The policy that pays first is called the primary. Okay? One pays first and one pays second. Primary pays first, excess would pay second. How do we know which one's going to pay out primary? There's a couple of key terms that you've got to be on the lookout for. If it is scheduled. We haven't used this term yet a lot yet. But if something is scheduled, that means it's specifically identified. It's set apart. It's listed.
Jewelry.
It's named.
Okay.
Yeah. Anything that you want to not insure underneath a generic type of coverage and you want to list it on its own, that is what scheduled is. Listed, named, specific. Okay? So if something is scheduled, it will always pay out primary. If it's unscheduled, if it's not specific, if it's generic, then that's going to be paying out excess. So I can have 2, but one's going to pay out first if it's listed, if it's scheduled, if it's named. What if both of them are listed though? What if it's both? What if it's both of them are primary, or both of them are an excess coverage? How do I determine who pays what? Then that's the term pro rata. Pro rata, where insurance companies pay proportionately based on the percentage of coverage. So in this example, let's just say you own a piece of property that's $100,000, but you don't want to use one insurance company to cover it. You choose 3. You've got insurance company A, insurance company B, and insurance company C. Insurance company A agrees that they'll pay 40%. They're like, okay, well, that's a good start, right? Then insurance company B is like, okay, we'll pick up 10. And then company C is like, oh, all we have to do is pick up 50? No problem. So we're paying 3 different premiums here, which I know seems kind of astronomical, but who cares? That for purposes, that's what we're doing, is we're actually dividing up this loss. So let's just say then, on a $100,000 loss, my home is completely destroyed, how much is A responsible for?
40%.
40,000, right? They'd only pay 40,000 of that 100,000 loss. B would only pay 10, and then C would pick up the rest. See, this whole amount right here has to equal 100. It can't go over that though, right? But what did you do? You just divided it. Everyone pays their fair share. That's what the term pro rata means. Yes, sir.
So would the deductible come out of that since they're not covering the total loss?
What's that now?
Because you said like if it's a total loss, you don't
Uh-huh.
have to pay the deductible.
Right, on a
Since-
total loss, you don't
but
have to
since
pay your
they're paying
deductible.
only a percentage of it, do they take out the?
That's a good question. The test won't get that specific
Okay,
though.
okay.
It's a good question though. I've never been asked that, but I've never seen anything get that
Okay.
specific. Okay. Just need to know what the term pro rata means, and that's everyone pays their fair share. Okay. Maximum limits of liability. The insured must prove insurable interest when? When do you prove insurable interest on a property claim?
On the loss.
The time of the loss. Right. Write that down if you don't remember that. What is proving insurable interest? That's proving that you are in a position now of financial loss now that that property has been damaged. And the company will never pay a limit any more than a limit that's stated in the policy. More specifically, the limit is stated on your what?
Declaration.
Deck page. You bet. Okay. So that's the maximum limits of liability provision. Also, the restoration or non-reduction of limits. After a loss, the limits will be restored for future losses. Okay? So let's just say that my home is completely destroyed by a tornado in month 1 or 2 of my policy period. Okay? So the insurance company has now paid out the entire limit of that policy in that first month or 2. My home gets rebuilt, everything's good, we're into the 9th, 10th month of my policy, and another loss hits that house. Only this time, maybe it's not a total loss, maybe it's just a $10,000 loss. Just because you maxed out your loss on the original claim, does that mean the insurance company's not gonna pay this one?
No.
No. Your limit is specific to the claim only, not to the policy period. Okay? Also need to know the difference between vacancy and non-occupancy. If your property is vacant, that means it is empty of both people and contents. And where is this specific? Remember, when we're talking about losses caused by vandalism and malicious mischief and theft, remember I said if my property was vacant for more than how many days? 60 days, the insurance company wouldn't pay that loss, right? But you have to know what vacancy means. That means that there's nothing in it and there's no people. Like right now, my home, I pray, isn't vacant. I just hope it's unoccupied,
Right.
right? Because if it was vacant, that means all my stuff would be gone. But it's unoccupied because obviously there's no one home right now. Got to know the difference between vacancy and unoccupied. This next one, pardon me, coinsurance. Carrying enough insurance to value. That's what we're talking about here. Making sure you're carrying enough, making sure you're never underinsured, okay? So it requires the insured to maintain a coverage limit that is at least, please underline this percentage, this makes all the difference in the world on this provision right here, 80% of your value, of your RCV, replacement cost of the building at the time of the loss. So let me say if I own a $100,000 home and I insure it for $100,000, which is my RCV, right? What is the minimum amount of insurance though my insurance company could have made me carry on that? 80,000, right? 80%. So at no point do I have to carry 100% of insurance, right? According to this provision, I do have to carry at least 80%. Think about this situation that I already threw at you a few times already. I own a $100,000 home, right? But I only insured it for $40,000. In the event of a total loss, who got hurt?
You did.
I did. But in a partial loss, say I own a $100,000 home, insured it for 40 grand, and I had a $10,000 loss. Is the insurance company going to pay me the entire amount of that $10,000 loss?
Oh, no, because you're not at.
Because you're not at 80%.
Right.
They're going to penalize you. Okay? And you need to know how they're going to determine how much to penalize you. Let me be very clear, this is not a math test, but this is a question that you might see on the exam where you will have to use some math skill, okay? So I'm going to break down these kind of questions in a very simplistic form. In order to figure out the penalty, to figure out if you don't carry enough insurance, there are 3 questions you have to ask yourself. So now, in that blank spot down there underneath that fraction, I want you to write out the letters A, B, and C. And we're going to break this down in the best way I know how. You have to ask yourself 3 very simple questions, and all 3 of these answers will be given to you in some way, shape, or form on the question itself, right? In order to find out how much they're going to penalize you, they have to give you all 3 of these answers. You just have to know where to look. So the very first question you need to ask yourself is, how much insurance do I have? Where do you go to find this answer?
Right down.
Your policy deck page. More specifically, your policy what? Limit. Right? This is how much you decided to write your policy for, okay? This is how much you decided to write your policy for. So where do I find this? This is my policy limit. What I decided to write my policy for. Okay? The next question you have to ask yourself is, how much insurance, excuse me, do I need? Where do you find that? Any guess?
The same place?
Nope.
If you're into the laws,
You have to take your replacement cost value, right? Your RCV, and you have to insure it for how much of that? Excuse me, 80%. Yep. 80% of your RCV. That's where you find that answer. And the last question you have to ask yourself is real simple. How much was your loss? Whoops. You know what I'm trying to write there. And of course, all 3 of these pieces of information will be given to you in some way. Right? The question would be worded, you own a home for $100,000. You chose to insure it for $40,000. How much would you pay in the event of a $10,000 loss? Or how much would the insurance company pay in the amount of a $10,000 loss? Okay? That's how the question would be worded. So what is the answer to A in that example that I just gave you? How much insurance do I have? $40,000. That is correct. Okay? So $40,000 would have been my answer to A. What's my answer to B? $80,000. Does everyone know why it's $80,000? Because it's 80% of your home value, right? This is not $100,000. We understand why, right? It only has to be 80%. And then, of course, the answer to C then is still 10,000. All right, so now what did I do? I found the answer to all 3 of my questions here. Now I can plug them into this formula, but I'm going to simplify the formula a little bit better than the way it's worded down here. So this is a fraction, and I know you're probably scared if I use that term fraction, but don't be. Okay? But on the top of this fraction, I have to put the number that's my limit of coverage, also known as letter what? What's your limit of coverage? A. What's on the bottom? The limit required, which is B. Multiplied times
C.
See what we're doing here? So now that I know what the formula is, and now that I have answers to A, B, and C, what am I going to do? Just plug it all in. 40,000 over 80,000. Stop there. If you're not good with fractions, there's an easy way to find the answer to this. You take 40,000, divide it by 80,000 in your calculator. Are you allowed to have a calculator on this test? You are. Okay. But if I do this, if I put 40,000 divided into 80,000, that comes up as 0.5. Or those of us who are good at fractions, we can obviously simplify this down into what fraction? Which is also 1/2. Right? Everyone see how I got to 1/2 or 0.5? At least one of the 2 ways. Okay. So what do I do with that 1/2 or that 0.5? I multiply it times my loss. So on a $10,000 loss, how much of that would the insurance company actually pay out? $5,000. See, they penalize you, right? They don't pay the full amount because you underinsured your home. Are we clear on that?
Yeah.
Okay. All right, I'm gonna give you some more numbers, so write them down wherever you have a chance, and I want you to try and figure this one out at your table there. So you own a $50,000 home. And yes, you can get out your phones to do the calculator part of this too. You own a $50,000 home, you insure that $50,000 home for $30,000. And you suffer a $10,000 loss. You own a $50,000 home, you insured it for $30,000, and it suffers a $10,000 loss. I want to know how much the insurance company is going to pay of that $10,000 loss. When you think you know the right answer, just raise your hand. I'm going to come to your table and I'll tell you if you're right or you're wrong. And then we'll take another break. Answer the 3 questions first. A, B, and C. How much insurance do you have? How much insurance do you need? And how much was your loss? Then plug it into the formula and it'll give you your right answer. Remember, it's a penalty, so it's going to be something less than what you originally had. Good job, Tess. Nice job. Yep. Just take it step by step. Do not allow yourself to be overwhelmed. That's why we do it on a question by question basis. Find out the answer to 1, then find out the answer to 2, then find the answer out to 3. It's just a step by step process. Anyone else have any answers they want me to come look at? Not yet. No. No.
Was it 50
You don't.
The cost was 50,000.
What's that?
The original cost.
No, you've got it. You've got it.
Switch to
Yeah. How do you figure out 8% of 50? It's just multiply it times 0.8. Yeah, sorry, I guess I didn't address that. Thank you for bringing that up. Yes, sir. Nope. What you got, Tamara? That's okay. All right, guys. I can tell some of this is tripping you up. So we'll do this one again here in class, and then I'll probably do another one right after break, just so we can really hammer this home. So what is the answer to A? On this question, on my example here, what is the answer to A? How much insurance do I have in this example? I have $30,000, right?
Yeah.
Okay, so that's answer to A. Okay, how much insurance do I need?
46.
Nope.
40.
I need $40,000, and here's why. I had how much of a house? Or how much did my house, was it worth?
50.
50. What is 80% of $50,000? It's 40,000. Now, I didn't go over this in class, and I apologize because I shouldn't have assumed this, but if you're trying to find 80% of something, multiply it times 0.8 in your calculators, okay? So if you multiply 50,000 times 0.8, you would have gotten what? $40,000. $40,000 is 80%. So are you underinsured here? You bet you are. You should have been carrying 40, but you didn't. And how much was your loss? 10,000. So now you just plug in the numbers. What goes on top? 30,000. What goes on bottom? 40,000. Stop there. What does that simplify down into?
0.75.
Yeah, you can either take 30,000 and divide it into 40,000, which gives you 0.75, or it's 3/4, right? 3/4 is what this simplifies into. And then I multiply this times my loss, which was still 10,000. What is 3/4 of 10,000? $7,500. So there's 3 different facts. Do you own a $200,000 home? You decided to insure it for $40,000, which I know is completely unrealistic, but once again, we're just doing this for test purposes. And you have a $10,000 loss. Okay, so you own a $200,000 home. You insured it for $40,000 and you suffered a $10,000 loss. I'll let you guys try it there at your desk real quick. If you think you come up with the right answer, just raise your hand. I'm already seeing much more better processes than I did the first time, so that's awesome. Yep. Yeah, this is good. You got it. Yep. Yep. Oh boy.
I pushed 0.
$1.6 million. Not quite that one. Yeah, but I'm seeing good processes though, guys. This is encouraging. So what is your answer to A? How much insurance do you have? 40,000. How much insurance do you need? This is the key.
160.
Right, 80% of 200,000 is 160,000. Okay? And 40,000 over 160, you can simplify it one of two ways. Put it in your calculator and it comes up as what fraction? 0.25, or simplify it down to a fraction and it's 1/4, right? 4 over 16 simplifies into 1/4, and then a quarter of $10,000 is $2,500. Okay, so on a $10,000 loss, in that rare case, they'd only pay $2,500. Now, if you're still struggling with this, it's okay, but we do need to keep moving forward. So if you're still struggling with this, come in and talk to me. I'll be happy to work you through it. But there's also some examples in our first practice test where you'll have another chance to try it out. But as we keep moving forward, there's a few more provisions we need to talk about. The first one's called the Gramm-Leach-Bliley Act. The reason why we use this term Gramm-Leach-Bliley is because these are the senators that wrote it. But guys, all it basically does is it regulates privacy within an insurance contract. So just do me a favor and underline that phrase, or that word right there. I'm not going to read through the whole paragraph. What it does is it just regulates privacy. It basically says the insurance company can't sell your information to someone else, okay? Because they have private information of yours, right? Confidential information. We don't want them selling that to a third party, and they can't. The Terrorism Risk Act is a law that required commercial property to be insured for losses caused by terrorism. And the reason why we have this actually in play is because before 9/11, no insurance company would have any problem insuring for losses caused by terrorism. Right? It wasn't ever something that would ever be considered an exclusion. But after 9/11, with the absolutely terrible, tragic loss of life that was also a huge property damage situation as well. Right? And we can understand why. Right? So insurance companies, though, that started insuring commercial buildings after 9/11 tried to make losses caused by terrorism an exclusion. Federal government stepped in and said, no, you don't. Cannot do that. Okay? So according to the Terrorism Risk Act, they have to cover losses caused by terrorism. Now, named insured conditions and provisions. You need to be very familiar with that two-word phrase. Who is the named insured? This is the person who you want having all interaction with your insurance company. See, most insurance contracts have more than one insured, right? My kids are an insured. My wife is an insured under my homeowner's policy. But who do I want making all changes to that policy? Who do I want having all interaction? That is me. That's why I'm listed as the named insured. Now, of course, is my wife a named insured on our homeowner? She is as well, of course. But you need to know who a named insured is compared to an insured, okay? The named insured is the one who has all responsibilities within a contract. Now, there are a couple different things that they have to do. First off, after a loss, they have the responsibility of notifying the police if it's a crime. See, if you're the victim of a crime and you notify your insurance department, your insurance company first, if they're a good insurance company, they'll hang up on you and tell you to call the police. Okay, you gotta call the police first if it's a crime. Then after that, then you call your insurance company, or if it's not a crime, it's just a loss that you suffer, you need to notify your insurance company. So that's the first step, it's notification, right? You have to notify the right party. The second step is a very important step. You have to protect that property from any further loss. Right? And that could be a couple of different things. That could be adding a temporary repair, right, where you're going to have to board up a window, or you have to tape something up, or you're going to have to find a way to remove that property, the damaged property, from the undamaged property. Right? You've got to find ways to limit losses here. That is your responsibility as an insured. You have to notify them of a loss, protect it from further loss, and then you have to file the proof of loss. This is where you prove insurable interest, right here. This is where you prove that you had ownership in that property and that you should be compensated for a loss. So that is what the proof of loss is. This is where you're proving insurable interest, okay? Within 60 days showing value, evidence, and receipts, proving that it was yours. The second provision that is your responsibility is, or your right, excuse me, is the right of assignment. We see this term assignment used in across all policy lines, but what does it basically mean? It means that you as the owner of this policy have the right to assign ownership rights to somebody else. You're not transferring what's being insured. You are transferring the right of the policy to somebody else. Those are two very different things, okay? So if you see this term assignment, I want you to break it down. What is the root word of assignment? It's assign. What are you doing? You're assigning ownership rights to somebody else. You are not transferring what's being insured. You're transferring who owns it, right? Ownership rights of the policy itself, okay? You have that right. That's called assignment. Now, can you assign? Absolutely, but you have to have two things that have happened. Number one, you have to get approval from your insurance company. That's one. And any type of change that's made to any insurance policy has to be done in writing. Right? That's why when you call an insurance office and you don't get an answer, you have the voicemail that picks up and it says no changes can be made to your policy over the phone, right? Excuse me. You have to do them in writing, okay? So once again, it has to be with the insurance company's approval and it has to be done in writing. Last one, lawsuit against your insurance company. Do you have the right to sue them? Of course you do. In fact, in the state of Kansas, you have up to 5 years to sue after a loss. Why would you? Because the insurance company didn't pay what they said they were going to pay, or maybe they paid something but they didn't pay enough, okay? So yeah, you have the right to sue, of course you do. Now, the insurance company says, you want to come at us? Go ahead. You have up to 5 years to do so. However, you had to have complied. What in the world is that? Sorry, that was weird. You have to have complied with all policy provisions first. Okay, what does that mean? That means that you have to have proven that the loss happened during the policy period. You had to prove that it happened where it did. You had to have paid your deductible, right? Because if any of these hadn't happened, if you weren't fully insured, there would be a reason why they limited your coverage, right? Limited your payment out of that claim. So if you could prove, though, that you complied with all of these policy provisions, then they say, okay, after you've complied with all provisions, now you have up to 5 years. So it's almost like a two-step process, right? You have to kind of go through the checklist. Did I comply with everything there? If I did, now I can file a lawsuit. Up to 5 years. And that's specific to Kansas, so you need to know that time frame for Kansas. Insurance companies, conditions, and provisions. So these were provisions that were specific to the insured. Now we're going to talk about ones that are specific to the insurance company. Number one, the insurance company has the right to liberalize your policy. What does that mean? That means to expand it, to make it better. The insurance company has all rights to revise your policy to make it better as long as they don't mess with your premium. They don't need your approval is basically what I'm saying here, right? They can make any changes that they want to this thing and they don't need your approval. However, if they want to make the change to your policy that requires a new premium, they have to get your approval. Right? But that would make sense though, right? If you're going to make my policy better, yeah, you don't have to ask me, just go ahead and do it.
Right.
Okay? That's what liberalizing your policy means. Also need to be familiar with this term, subrogation. Requires the insured to transfer their right of recovery against a person that is responsible for damage to their property. The insurer steps into the shoes of the insured. So let me ask you this. If someone were to damage my property, right? Would I have the right to sue them for that?
Yeah.
Yeah. Right, of course I do. If someone damages my property, I've got the right to go after that person, right? I've got the right to recover money from them. So when you say right of recovery, basically what you're saying here is you have the right to sue. But here's what happens. If I file a lawsuit against someone, what's going to happen? Their insurance company is going to fight me. There's going to be investigation. There's going to be defense. We're going to probably go to court. I'm probably going to have to pay a lawyer. And it could be 6 months to a year or 2 years before I even see a cent, right? That's what could happen. Or instead of filing lawsuit, what do? I file a claim with whose insurance company? Mine. And if I file a claim with my insurance company, will I probably get paid out a lot quicker? Probably. But now, do I have the legal right to still sue that other party?
No.
No, I don't. Why? Because I transferred that right. Right? I had the right to sue, but now I don't. I transferred that right to who?
To my insurance.
To your insurance company. Now, will your insurance company go and probably try and sue the other person and try and get their money back? Oh, of course they will. Of course they will. But they've got the time, they've got the resources, and they don't need the money immediately. I did, right? I needed that money now, so that's why I filed that claim with my insurance company. That's what subrogation is. Okay? Got to know what this term is, guys. It's one of the most commonly used terms when it comes to property and liability insurance. It's transferring your right to sue. Okay? That's what subrogation is. Salvage. Insurance company has all rights to salvage value once they pay for the damaged property. What does that mean? Once they pay for the property, it is theirs. And they can do with it whatever the heck they want. They can trash it. They can try and resell it. They can try and repair it. They can do whatever they want. What are they going to do? They're going to limit their losses as best they can. Right? If they can even turn around and sell that damaged property for 1/10 of what it's worth, who cares? They limited their loss, and they have every right to do so. Okay? That's what salvage value is. Loss settlement, replacement cost usually provided on buildings. We already know what that is, right? That's the cost to repair or replace it at today's labor and material. When do you want your property back? I want it back now. Contents and outdoor property, though, are covered on an ACV basis, which of course means you are going to take into account how old it was, how much it went down in value, right? And how much that property had deteriorated. Loss payment. This is who the loss gets paid out to. So the insurance company adjusts all losses and pays those losses within how many days?
30.
We remember this from our pre-study, right? They have to pay the loss within 30 days after a proof of loss is filed, after a court judgment, or after an appraisal award. Also need to know what an appraisal award is. And an appraisal award is basically this. Your insurance company and you are having a dispute, right? You say they owe you money, you say they owe you money, they say they don't, right? Maybe they didn't pay enough, or maybe they didn't pay it at all. Right? We have the right to sue them as long as we complied with all policy provisions, but even if we do, we may not come to terms on something. So here's what we might actually do. We could enter a process called binding arbitration. Okay? You need to know that phrase. It's listed right here. Where is it? Binding arbitration. Or is it on this one? Nope, it's not. So yeah, write in the phrase binding arbitration here, because this actually defines what binding arbitration is. So both parties have their own appraisers, right? They both appraise the situation. Neither one of them are coming to terms. So what are we going to do? We're going to hire a third appraiser. We call this person the umpire, or another word we use to describe this is the arbitrator. And this person views this case from a completely objective standpoint. They will look at it from their point of view only, right? And they will look at the facts of the case. They can't be biased to me. They can't be biased to the insurance company. But when they render a decision, whatever they decide is what? Final. Binding. That's why we call it binding arbitration. Okay? So that's what loss payment is speaking to then, is if the judge or the appraiser or the umpire awards something to me now, the insurance company has only 30 days in which to get it to me. Right? Loss payment. They have to pay all losses within 30 days. Loss to repair or set. When it isn't considered a total loss, the insurance company will repair, replace, or pay the difference in value before and the value after the loss. Can I erase this? Is everyone good with this up here? Okay? All right. So what this is speaking to now is if you have a set of things that you own. Let's just say you have a set, an expensive set of antique plates. Okay? So you have this set of antique plates, 3 of them in the set, and you take it to an appraiser, and the appraiser values that entire set at $30,000. Okay, so if I have this plate set at $30,000, and then my son, the covered peril, right, comes along and he damages one of these plates, the insurance company, you would think, would actually pay me what?
$10,000.
It would make sense, right? That looking at this outline, you would think that they'd pay you $10,000, but that is not true. Because here's what's going to happen. You're going to take this set back to the appraiser. And the appraiser's like, oh crap, he broke that plate. Because even though it was only one plate, now your set is only worth $10,000. Now, if this set is only worth $10,000 in its whole, just those two, how much does the insurance company actually owe me for the loss of one plate? The difference in the value. They would owe me $20,000. Why? Because this was the value before the loss, this was the value after, and they've got to pay me the difference. Okay? So as you're looking at this definition, underline this phrase right here. Difference in the value. From before the loss to after the loss, that's how much they owe me. Right? Let's say hypothetically I go back to them and they say, well, Mr. Kemper, it's a shame you broke that one, but you know what? That one's the one that's easy to find, right? That didn't add much value to your set. This whole set is still worth $27,000 because you still got the two most antique ones, right? The ones that are more harder to find. So even though one plate got damaged, how much would they still owe me for that one plate? Just $3,000. That's all they'd owe me, right? They don't have to owe me 10 just because one. This is not a proportion question, okay? It's based off the difference in the value. Okay? All right, recovered property. The insured must either return the found property or the amount the company paid. This is in the event of a theft claim, right? Because in the event of a theft claim, what did they do? They paid you for the value of the item that got stolen, right? Well, what happens if the property actually is recovered? Sometimes the insured can be like, yeah, the property that was stolen is worth 10 times more to me than any stupid claim check you could give me, right? So do I have the right to recover that property? You bet I do. However, if I recover the property, what do I now owe back to the insurance company?
The amount they paid.
Yeah, the claim check, right? You can't keep both,
Right.
okay? But you do have the right to recover your property if they find it. That's what that provision says. Glass replacement. Replacement cost is provided for all glass damage, and the insurance company will replace with safety glass when it's required by ordinance or law. It would make sense why glass replacement is only RCV though. Doesn't make sense to insure glass with ACV, right? You can't replace glass in the same kind of condition it was in before the loss. That wouldn't make any sense. And the last one, it's called our option. So the insurance company does not have to make a cash settlement. In this case right here, they could cut me a check for $3,000, but they could also find a way to repair or replace this plate. Right? They could go to an auction and they could maybe find another plate that's in the exact same condition as my old one was, and maybe they only pay $1,500 for it. If they only paid $1,500 for it, don't you think they'd rather do that instead of cutting me a check for $3,000?
Yeah.
Right? They're going to try and limit their loss so they don't have to make me a cash settlement. They can just repair it or replace it, but they have to repair it or replace it the same value that it was before the loss. Okay. So that's what our option is speaking to. A couple other provisions we need to hit on. Mortgage clause. It's used when a mortgage is outstanding on the property, protects the interest of the mortgagee, and allows the lender to file a claim if the insured fails to do so. Preserves coverage for the lender in the event the insured intentionally damages the property. Why? Because if the insured intentionally damages the property, can they file a claim?
No.
No, but who can? The mortgagee, right? Don't you think they have just as much insurable interest, if not more so, than the insured? Yes. So property insurance is normally a two-party contract unless there's a mortgage on the property. Then there's three, right? Because your bank, the mortgagee, has just as much insurable interest as you do. And in the event that the insurance company wants to cancel you or even non-renew you, they now not only have to notify you, but now they have to notify your mortgagee, your lender. And whether it's cancellation or non-renewal, they have to give them 10 days notice. Okay, so there's another time frame there. Anytime you see time frames, unless I tell you so, you need to know them. Okay, 10 days notice is the mortgagee clause. And death. Legal representative of the insured becomes the insured only until the estate is settled. Guys, 1 through 26, that's a lot of provisions to remember, but that's a very definition-based section, okay? So this is a section where you could probably just go through and list the provision, and then on the backside, on a flashcard, write down what that provision does. Very kind of call and response way of studying this section. A few other definitions you have to know when it comes to property insurance. What is an accident? Well, quite simply, it's something that was unexpected, right? Of course, it has to be an accident in order for it to be covered by insurance. It can't be an intentional act. Agreed value, that's the value established and agreed upon by the insurance company and the insured that is used to secure the limit of coverage when the policy is issued. The limit is then the maximum amount available for a covered loss, even if the loss exceeds that limit, right? So this is agreed upon not only by you, but your insurance company. They're in on this as well. So they're always going to make sure that your limit is at least going to be 80%, right? They're going to try because they know that if it's less than, then that penalty is going to come into play, right? The only time the penalty wouldn't come into play is if the named insured maintains that agreed value. Then that co-insurance penalty, remember the 80% penalty, will not be assessed. Why? Because you're maintaining enough. Don't have to maintain 100, but you do have to maintain 80. The direct loss. That is a term you will see on this exam, guaranteed. What is the direct loss? It's what happened to the property, okay? So if my home is destroyed by $10,000 damage to the home because of a fire, what is the direct loss? The $10,000. But think about this, guys. If my home is destroyed to the point where I can't live there for a while, what am I going to have to do? Gonna have to go stay at a hotel? Probably gonna have to go out to eat a few times, or at least go out and buy some groceries, stock up the hotel fridge. Probably gonna have to use a laundromat, right? There's gonna be extra expenses that I'm gonna incur as the result of that direct loss. Can I call all of those financial losses direct losses though?
Yeah.
No,
No?
because it's not the direct loss to the property, but it did happen as the result of the damage to the property. So we don't call those direct losses, we call those indirect losses. Right? It happened as a consequence. That's why we're calling them consequential losses as well. You can't use your house. And because you can't use your house, you're going to suffer some extra losses, right? Or this also would come into play in like a landlord situation, right? Where if a landlord was renting property to someone and that home gets damaged, not only has the landlord now got to find a way to pay for the damage to the home, but can he rent that home for a while? Probably not. Is that going to be a loss of income to him? Of course it could be. So that could be described as a consequential or an indirect loss as well. Got to know the difference between those two terms, direct and indirect loss. Limit, we already know what that is. Refers to the dollar amount of coverage. Limits, normally found on the deck page. However, some special dollar limits will be found on the inside of the contract, and we'll talk about those when we get to homeowners. Loss valuation, ACV, RCV. We've already kind of hit those a few different times now. So hopefully those have sunk in. We know what those are. This is one we haven't talked about yet, though. It's called market value. See, sometimes you can only insure your property up to its market value, which means the cost, the current selling price of your building. It's used to establish your limits when you're talking especially about older buildings. Right? Say I own a $50,000 home, but the market value on that $50,000 home is only like $20,000. Is an insurance company going to insure it for 50 grand? Heck no. Right? That wouldn't make any sense to them. So what do? They only insure it for the market value. It goes back to that saying, something's only worth what someone's willing to what? Pay for it. Okay? So once again, when you're looking at market value, that would be the limit of coverage. That they're going to say, hey, we're not going to insure anything more than this. You want to insure it for less, fine. But we're not going to go anything over what the market value is. An occurrence is an accident, so it's a sudden unexpected event. That's the first thing you have to know, including a continuous repeated exposure to substantially the same general or harmful conditions. Because remember how we could say there was one event. It was all happened as a result of one event. It could impact a long line of different things, right? It could be a consequence after consequence. It could be years. But if it can all be traced back to one event, one accident, the insurance company may not pay anything more than that one amount for that one occurrence, okay? So that's why you have to know what that term occurrence is. And we're going to see this a lot tomorrow as well. So you need to know what that term occurrence is. It's the one-time event that could cause a string of different consequences. Package policies. What are package policies? They've got two different types of coverage in them, and you can't endorse either one off. They have to have both property and liability. We've been addressing property insurance all day long so far. If it has to have property and it has to have liability in it, that is called a package policy. We're going to look at the most common package policy that we know of right after lunch. It's called the homeowner's policy. Right? Because if you buy homeowner's insurance, it's got property coverage and it's got liability in it. Okay? We've already broken down the difference between scheduled and unscheduled, so I really don't want to go over those definitions again. We already know the difference between vacancy and unoccupancy, so we're not going to go over those as well. This is just review, right? So hopefully, if anything, you want to go back and review those in a different time, you can. Blanket coverage, one policy covering several locations or items. It's a more efficient way to provide coverage for certain kinds of property or situations. So a lot of terms that some of them we've used today, some of them we haven't. But you will definitely see terms like this on the exam. Right now that you see these terms, you're going to know what they mean and hopefully know how they're going to apply. For the next few minutes, though, what we need to do is we need to kind of take a break out of property insurance. Okay? So up until this point, we've been talking about property insurance, and property insurance is insurance that protects who?
Insured and
You,
insured.
right? It protects you if your property is damaged by a covered peril. But now we're going to talk about liability insurance. Now, liability insurance is going to cover you, however, it's going to protect you against anything that could happen to who?
Somebody else.
Somebody else. See, guys, when you're using the words liability insurance, I almost want you to think of another word, and you're not going to understand why. You're just going to hear it in your head, and it's the word others. Okay? If you hear the word liability, this is not protecting you anymore. Right? This is protecting others because of something you did. There's two different types of liability coverage. You're going to hear these words used a lot over the next 2 days, so you might as well become familiar with them. If you cause bodily injury to somebody, or you damage their property. Bodily injury and property damage. Those are two terms that are very synonymous when it comes to liability insurance. Okay? So it protects you when you become legally liable because of bodily injury or property damage to somebody else. This is a three-party contract. You, your insurance company, and now the person that is suing you, the claimant, the person who is coming after you because they feel like you owe them money. Okay? It's three parties here. The insurance company will pay for all sums up to the stated policy limits for which the insured has become legally liable. So, is liability insurance unlimited? No. No, it's not. It's going to have a limit just the way that property insurance did. Okay? Now, it's not going to be based off the same thing, but your liability policy will have a limit that it won't pay anything more than. Okay? The policy, though, also pays all investigation and defense costs, including attorney fees. Please start underlining right here, in addition to your liability limit. Guys, when we were just talking a few minutes ago about the property limits you said on your insurance, was there any chance your insurance company would ever pay anything over that? Not on property, there wasn't. Your limit was it, right? They wouldn't pay a cent over it, whether you underinsured yourself or not. But see, under liability insurance, that's not true. Because under liability insurance, they have a limit for which they're going to pay. They're not going to pay over that unless it was their way of defending you or investigating that case. Why? Because they're going to fight for you. Remember how I said if someone sues you, they're probably your insurance company is going to want to fight for you. They're going to want to investigate that. There's going to be court costs and defense costs and legal costs. Yeah, that's paid for by your insurance company. Why? Because if they defend you, if they fight for you and they win, what do they have to pay? Nothing. Right? They don't have to pay any of the damages. All they ended up paying was the court costs, and that was it. That's why they want to do that. Okay? And that won't affect you. That won't affect your limit. That does not go toward bodily injury. That does not go toward property damage. Okay? So, when you get a question about what affects your limits, it's the bodily injury and property damage award. But it will not affect your limit if they investigate you, if they defend you, if there's court costs, attorney fees, any of those things. None of those affect your limit. Okay? There are a couple other exclusions when it comes to liability policies you need to be aware of. First one, boy, I sure hope you know this one by now. You do something on purpose, that's not going to be covered by liability. You damage someone's property on purpose, you physically injure them on purpose, will my liability policy pay for that out of my pocket, or out of their own pocket? Of course not. Remember, insurance is only there to cover you in the events of accidents. Okay? So your liability insurance will not cover you if you do something on purpose. Another reason why your liability policy wouldn't pay is if it was covered by another type of liability policy. So you can't double up here. Business would be excluded on personal. Right? If you could be covered underneath business liability, that can't be covered on personal as well. And we'll talk about examples of that tomorrow. Damage to property owned by, rented to, occupy, used by, or in the care of the insured. So the one here would make sense. owned by. Well, yeah, any property owned by me can't be covered by liability, but keep reading. Rented to. If something has been rented to me and something happens to it while it's in my possession, is my insurance company going to pay for it? Why? Because I have no what? Insurable interest in it. But was it under my care? Was it in my custody? Was it in my control? Yeah. So if it was under my care, it was under my custody or under my control, my liability policy will come back to me and say, nope, we will not cover that. That's called the care, custody, and control exclusion. Please underline this, guys. I can't emphasize that enough. It does not have to just be owned by you in order to be excluded. If it was under your care, custody, or control, that's not going to be held for by liability. I always used to think my dad was kind of a little strict when I was growing up. He said, if you borrow someone's property, you return it in a better condition than it was when you got it. Well, now I kind of know why. Because if you don't, and it would have been damaged, your homeowner's policy can't cover it. Their policy could, but are we going to ask them to do that? Probably not. What are we going to do? We're going to have to pay for that out of our pocket. Okay. All right, so care, custody, and control exclusion, that's the big one when it comes to liability exclusions. Now, a couple other definitions when it comes to liability insurance you have to know. The first one is the term negligence. Okay, so this is one way that they're going to prove if you're legally liable, is if you were negligent. What does that mean? You did something that somebody else wouldn't have done in that same or similar circumstance. Okay, so look at that definition. Failure to do what a reasonable person would have done under that same or similar circumstance. Say I'm in my front yard and I'm watering my garden and I leave my hose out in the middle of that yard. If someone were to come along and trip on that hose, could they prove that I was negligent? Yeah, because reasonable people would have done what? Put the hose away, right? Wheeled it up. See, if I have any three of these people on my property, I owe them a standard of care, okay? If I have someone invited to my house, I owe them the greatest standard of care. Why? Because would they have been at my house had I invited them? Probably not. So you owe them a greater standard of care. If you're inviting someone over to your home, you better give them a safe environment, is what this is saying. Right? But even a licensee, someone who has every right to be on your property at any point, friends, family, garbage collectors, mail, people who deliver your mail, people who go and check your meter, right? If anything happens to them while they're on your property, they could prove maybe that you were negligent as well. Even a trespasser, someone who wasn't even supposed to be on your property, maybe someone who was just cutting through my lawn just because they didn't want to walk on the street. If they were to trip over that hose, could they still sue me and prove that I was negligent not putting away that hose? They could. Guys, even if I can prove that that trespasser was there for criminal reasons, they could still sue me. That's how that works. So you need to know all three of these definitions. Invitees, licensees, and trespassers, you owe them a standard of care, even if they weren't supposed to be there. Right? So that's what negligence is. Who proves that you were negligent, or who decides if you were negligent? It's tort or civil law, or betterwise known as a judge. Right? The judge determines whether or not you were negligent. Also, two other ways that they can determine, or I'm sorry, I need to go over this definition first. Proximate cause. Proximate is exact or direct. In liability insurance, it's the occurrence which causes an unbroken chain of events resulting in injury or damage. In property insurance, it's the relationship between a peril and a loss. Guys, if you see this term proximate on the test, think of another word, and that's the word direct. Okay? It's almost like a word association thing, right? As soon as you hear the word liability, what do you think? Others. Whenever you hear the word proximate, what do you think? You think direct, right? It's almost like you don't even know why. You hear the word, you see the word proximate on the test, and then you hear Andrew on your shoulder going direct. Seriously, that's what I want it to be, okay? Direct. If someone gives you proximate directions, they're giving you turn-by-turn directions on how to get there. Approximate would be like, oh, it's over there, across the street from that church, up there. Yeah, no. Right? That's not direct, okay? All right, there's two other ways, though, that they can determine if you're liable. First one, absolute liability. Absolute liability is responsibility without fault or negligence. So you don't even have to be negligent in order to be liable. That's one way. But if I possess a hazardous property like a chemical or an explosive or a dangerous animal, I can still be held liable for any damage that those items could cause, even if I wasn't negligent in doing so. right? Say I own a dangerous animal. Let's just call him an arm eater, for lack of a better term. Okay? So if I keep arm eater penned up, right? I keep him chained in his fence, and I take care of him, and I make sure I've done everything I can to make sure he doesn't get out, but yet he still does, and causes damage to somebody or something, can I still be held liable for it? Yeah. Doesn't matter if I was negligent. Doesn't matter if I took good care of him or not. I'm still held liable. Why? Because I owned him. Guys, this absolute liability has to do with one word. Write it in here. It's the word ownership. You owned that piece of property. You owned that explosive. And even though you took care of that explosive, even though you put it in the right, you took care of it, you put it in the right environment, it still went off. It still damaged someone, and yet, or someone's property, and now you will still be held liable for it. Okay? Doesn't matter if you were at fault or negligent. It only mattered that you owned it. Are we clear on that one? Okay, that's absolute liability. Strict liability is used to establish legal liability when a customer is injured by a product. So what this means is that people who manufacture products are going to be held liable for any injury their product might cause, whether or not the person was using that product in a negligent manner. This is a dead-on true story. There was a gentleman who bought a Black & Decker lawnmower, took it home, used that mower to mow his front lawn. Now, this was also back in the days before you actually had to have the black handle, or the handle that kind of engages the engine, right? This was back where you could just pull the pull string and it would just run, okay? So he looked at the job that lawnmower did on his front yard. He was like, wow, that did a really good job. I bet that could probably do the exact same job on my hedge. And so he called up his neighbor, Tweedledum, and he came over, and Tweedledum picked up one side of it, Tweedledee picked up the other, and they started walking along this guy's hedge. Of course, we know what happened here. That didn't happen. They didn't make it very far. Why? Because chopped off that guy's fingers. He lost 3 or 4 fingers in that accident, and he sued Black & Decker, even though he was using that product in a negligent manner. And guess what? That guy still won $5 million. See, the manufacturer of the product can't be held liable, or can be held liable, even if that person was using it in a negligent manner. The only way they could have gotten out of that lawsuit was if that guy if they did have a black handle on it, and he used a zip tie to tie it. He tampered with it, right? He had found a way to intentionally disengage the safety mechanism, then they wouldn't have to pay that, right? Because they could prove he was not negligent. He did an intentional act. But he was using the product, even though he used it in the wrong way. Yeah, that's what strict liability is. Both of absolute and strict, you don't have to prove negligence. You owned it, or you manufactured the product, okay? That's what strict liability or absolute liability is. Now, if I'm proven negligent, if I'm proven absolutely liable or strictly liable, then the judge now has to award damages. There's 3 different types of damages that he can award, okay? We're going to split them up into 3 different categories. The first category is special. Special damages are compensations for things like bills, loss of income, rehab, and other direct expenses. I'm going to use an easy term to remember what special damages are. Write it down. It's the term measurable. You can look at a piece of paper. You know what it is because you can see it. It's listed there. It tells you what the loss was. Those are special damages. But sometimes the judge has to award general damages as well. General damages are things like loss of companionship, pain and suffering, mental anguish. Are those measurable? Can anyone look at a piece of paper and identify what that's worth? No. A judge is going to have to determine what that's worth, right? So special damages are measurable, general are not. They are unmeasurable, okay? And I just saw a question like this the very last time I took this test a few months ago, asking me what pain and suffering was. That's a general damage, guys. It's unmeasurable. Okay? The third type of damage that they can award, the judge can award, though, is called a punitive damage. And guys, this is another word association trick. You hear the word punitive, I want you to think of the word punishment. You are being punished if a judge awards a punitive damage. What does that mean? That means that not only did he award special damages, not only did he award general damages, but that judge is ticked that you're in his courtroom for that reason. He's like, yeah, you shouldn't have been here to begin with, so now I'm going to punish you even more. I'm going to add on a punitive damage to make sure you never get put in my courtroom for this reason ever again. And punitive damages, since they're punishments, they're meant to try and set an example. Can that be covered by an insurance company? No. No. Punitive damages, guys, for purposes of this test, will never be covered by insurance. Right? That's like putting my 10-year-old son in the corner when he gets in trouble. That doesn't make any difference, right? What does make a difference? Take that boy's tablet away from him, and now he will learn his lesson. So that's what makes sense. But that's what makes sense, though, about what punitive damages are, right? See, if they were covered by insurance, no one would learn their lesson. They'd just be like, oh yeah, whatever. My insurance company will take care of it. Okay. All right. Now, when it comes to liability insurance, the provisions that are associated with liability are very, very similar to the provisions that we saw on property. Okay, in fact, as you learn to know all of these provisions, you're going to see, wow, I've already seen this term used again and again. You will, right? I'm telling you, the context of these provisions doesn't change. The application, though, does. All right, so let's kind of view how some of these work. Some of these we've already broken down. We're not going to spend a lot of time on. Maybe a few of them, though. Policy period. The policy period provision in liability insurance says what has to happen during the policy period. The loss does. Yeah, the accident. Right, that's all it boils down to, the exact same kind of way it did earlier. Cancellation and non-renewal. Under your liability coverage, 10 days notice for non-payment of premium. Does that look familiar? I hope so. 30 days for all other reasons. Exact same thing that we saw earlier. Other insurance. Remember, if there's two liability policies trying to cover the same kind of loss, one has to pay out first, right? That would be primary. That would be the one that's providing more specific coverage. And then the one that would pay secondary or second would be excess. Or if there's two of them that want to share proportionately, they can. 60% of the loss, 40% of the loss, right? As long as it only pays up to 100%. The limits in liability, though, work a little bit differently than property insurance. See, in property insurance, we just had the one limit, right? Based on the agreed value, and that was it. But see, in liability insurance, insurance companies come to you and say, okay, we don't care how many people are involved. We will have a specific amount that we're going to pay for that one occurrence, and that's it. That's why we have to know the definition of what occurrence is, right? Because remember, who cares what kind of consequences happen as a result of it? If it all happened as a result of one event, one accident, one occurrence, that's all they have to pay for, okay? That's per occurrence. It doesn't matter how many people, doesn't matter how much. They won't pay anything more than that. But the per occurrence isn't the only thing they pay. They only pay out a per person limit. So what this basically states now is that if the per person limit gets hit, then it doesn't matter what this is, right? Say I caused $30,000 in damage to someone, but my per person limit was only 10. My per occurrence limit maybe was 50, but who cares? If I max this limit out, does it matter what this one is? No. Okay, so that's what per person is. It's how much they're going to pay out per person. Aggregate limit, though, is how much they're going to pay out for all claims combined during one policy period. We didn't see this with property insurance, remember? There was the non-reduction of limits, right? How it didn't really affect what could happen during the rest of that policy period. Not necessarily true here. In liability insurance, there's an aggregate. It says we don't care if it's 1, 10, or 2 or 10 claims. Once you hit this limit, we're not paying another red cent until that policy period resets. And if you hit that aggregate limit, you may want to concern yourself with non-renewal at that point. They may want out of that, right? But if you hit the aggregate limit, that means they won't pay anything else, period. Okay? Sometimes they're split, which means it's a different limit for both bodily injury and property damage. We're going to see this in auto insurance tomorrow. So if you want to put these three letters right down here, you're going to have cross-reference called PAP, Personal Auto Policy. It's a split limit policy. And we're going to talk about a combined single limit policy later on this afternoon, and that's your homeowners. So you can just put two letters over here, HO. So we're going to see examples of how these limits can be split or how we're going to combine them. What does combine mean? It doesn't matter if it's bodily injury. It doesn't matter if it's property damage. This is how much we're going to pay, period. But if it's split, then this is how much we pay for bodily injury. This is how much we pay for property damage. Okay. We're going to see some more context of that later on, so I don't want to get you too wrapped up in that. The insurance duties in the event of an occurrence, claim, or lawsuit. Well, number one, notify the insurance company that something happened. right? If you know you're gonna get sued, there's an event, you probably know that something bad happened, you better notify your insurance company, and this time give them anything they need. Names, people who were there, the incident itself, right? Any type of details that you can. And here's the key thing. Cooperate fully, but do not make any payment whatsoever or assume any obligation. Why? If I make a payment or if I assume obligation to the third party, what does that automatically admit?
Guilt.
Oh, you bet. Can the insurance company fight for me now?
No.
No. It's on the books that I've admitted fault, right? I made a payment. Why would I make a payment if I was innocent? Okay? So that's why they don't want you doing that. Assignment, you have the right to transfer ownership rights under your liability policy, same way as you did with property. That's why we're not breaking that down, because we've already seen it. Liberalization, can they liberalize your policy? Absolutely. Can they make it better? As long as they don't mess with your what? You bet. Subrogation. Same way it worked with property insurance, only now, let's say I'm on Diane's property. If I'm on Diane's property and I injure myself, do I have the right to sue Diane? Of course I do.
Yeah.
But if I injure myself on Diane's property and sue Diane, what's Diane's insurance company gonna do? They're gonna well, they're not deny it, they're gonna fight for her, right? They're gonna investigate it, they're gonna, right, get courts involved. Am I gonna get paid out quick here?
No.
Heck no. So what am I gonna do instead? File the claim with my insurance company. But if I file the claim with my insurance company, do I now personally have the legal right to sue her?
No.
Who does?
Your
Your insurance company.
Everyone see how this works?
Yeah.
Yeah.
Subrogation. Okay. Bankruptcy. Bankruptcy of the insured does not relieve the insurer from their responsibilities under the policy. Why? Why wouldn't bankruptcy keep the insurance company from paying out a claim? We talked about this. It's a two-word phrase that we learned first thing this morning.
Insurer.
Nope. It stated the insurance company was obligated to us to pay a claim as long as we were under what?
Or policy.
Under contract.
Under contract.
What did we call that? Contractual liability. That's why bankruptcy is huge to understand that idea of that provision. Why? Because it doesn't matter if the insured is legally bankrupt or not. All that matters is that the policy was in force. See, someone can be legally bankrupt and still have a policy in force, can't they? Right? All they have to do is keep paying their premium on time. People who are bankrupt can still pay an insurance premium. So as long as a policy is in force, it doesn't matter if they're legally bankrupt or not. Insurance companies still have to pay out those losses. Legal action against the insurance company, can't sue the insurance company until all conditions have been complied with. We've already seen that. And separation of the insured. Coverage applies separately to each insured. This condition will not increase the limit of coverage that applies for any one occurrence. Last thing I want to look at is defenses. These are how liability claims get defended in court. Some of them you can use here in Kansas, some of them you can't. One that's not really as popular, or not really used as often, excuse me, is the term contributory negligence. Contributory negligence basically says this: if a person contributes in any way to a loss, they are barred from recovery against another person, even if the other person was mostly at fault. So if you're allowed to use this defense, all the other party has to do is prove that you played a part in it. The only way you could collect money out of this kind of a claim is if you were 0% at fault. Even if you were 10% at fault and the other party was 90, it didn't matter. You contributed to it. That's how you break that one down, right? Contributory negligence, you played a part, you contributed. Comparative negligence, though, it's different. So comparative negligence compares the negligence of all parties to determine the percentage of fault and the amount of the award. The person with the highest percentage of fault would pay that percentage of the other person's damages or injuries. So you have two parties here, Party A and Party B. It's determined that Party A was 55% at fault, Party B was 45% at fault. Whose insurance company pays out?
Whichever one is more.
The one who's more, right? Their insurance company pays out, but on a loss now, how much of that loss do they have to pay out?
Maybe 100%.
55% of the loss. See, they don't have to pay 100% of the loss when you're using comparative negligence. You're comparing both of them. So you won't ever see 100% of a loss paid out here. You will see percentages of losses paid out here, but it's all based on which party was mostly at fault. and it only pays out that amount. It will not pay out 100% of the loss. You played a part, you are comparing them. That's how you break these down, right? You contributed or you're comparing them. Assumption of risk doctrine. If a plaintiff voluntarily assumes risk, they could be barred from recovery. So if an adult was riding in the back of a pickup truck and so they got hurt in doing so, the judge would look at that and say, moron, you knew what you were doing. I'm not giving you any money, right? One of my neighbors jumped up in my tree a couple months ago to try and help me get some branches down. I didn't ask him to do it, he just did it. And all of a sudden the thought went through my head, oh crap, what if that guy falls, right? But then I'm like, any of my insurance company lawyers would probably use that. That guy knew what he was doing, I didn't ask him to do it, right? He assumed the risk, okay? Intervening cause, frees the defendant of liability. A student living at a dorm accidentally dropped a cigarette into a trash can that caused 40 grand in damage. This is actually a true story to the building and all of its contents. During the investigation, it was determined that the smoke detector failed. Let me ask you a question now. Think in a lawyer mindset. Can it be legally proven in court how much damage would have happened had that detector worked? That can't be legally proven now, can it? So can I ask the defendant to be 100% responsible for all the damages now because of that cigarette? I can't. Legally, you can't now prove what would have or would not have happened had the detector worked. So, because something got in the way, it intervened, right? That's what the term is. Intervened, it got in the way, and now caused a difference in the chain of events. You can now no longer say that this person was was directly responsible. What was? The smoke detector. See, the smoke detector in this case now becomes the direct cause, and it freed that defendant of any costs whatsoever. They didn't have to pay anything. Why? Because something got in the way. Common law determines this. Okay? When you see these terms, common law, that means judge. Okay? A judge has to determine if someone or something got in the way or someone assumed risk. And statute of limitations, lawsuits must be brought within a specified time period by law. In the state of Kansas, that's how many years? 5 years. Right? Everyone remember that? 5 years. All right. It's a lot of information, guys, to take into a 4-hour time frame, which we pretty much have been going about 4 hours now. So, but before you head to lunch, I want you to take this first test because I want to see kind of where we're at. We're not going to grade this test though until you come back from lunch. So everyone get out your practice test book and the answer key. That's where you need to write your answers. You're not allowed to write in the test book itself, please. We use those for every single class. And this is how I want you to go about taking your test. Okay? You don't have, what's that? Right here. This is the test book right here, and then you use your answer key. Yep. All right, so your answer key looks something like this. You've got the numbers with all the letters next to them. You're going to read through every single word of every single question and read through every single word of every single answer before you choose an answer, right? Now, when you think you know what the right answer is, you're just going to give me a big X right over that letter. That just is a big symbol to you that you think that's the right answer. Let's say on the next question you think you know what the right answer is. You're going to put an X, but now maybe you're double guessing yourself. You're not quite sure. Remember how I said you can mark questions for review on this test? I want you to be mentally prepared for how to do that. So I want you to just put a little dot right here. That's your way of marking it for review. That's something you might want to go back and check. Okay? So when you're done, your answer key should look something like that. But when you're done, I'm going to challenge you to say you're not done. Because I want you to go through and check your answers. The answer key's in the back of the book. Now, if you want to cheat on this test, you can. No one's going to prevent you from doing so. But the only person you're going to hurt, once again, is yourself. I don't give grades. Right? If I did evaluate this class, I'd probably give you a B because you're laughing at most of my jokes. I appreciate that. That one always gets a pity laugh. Thank you, Diane. Okay? I know they're bad jokes. I'm sorry for that. Okay? But no, I don't evaluate you guys. I told you, I want you to be learning from me at all times. So why do I want you to go through and grade this? It's not because you're evaluating yourself. Let me be very clear. Even if you only get half of these questions right, do not get down on yourself. Figure out why you missed them though, right? Go back in your book and figure out why you missed them. Spend some time breaking that down. But I am going to time you because I told you, you have 2.5 hours to take a 156 question test. That roughly breaks down to about 45 seconds to a minute per question. Okay? So I want you to work on your pace. I want you to work on your rhythm. I want you to work on your timing. I know I use a lot of musical terms here, but that's my musical background. But that's what this will take, right? You don't want to spend 2 or 3 minutes on every single question, and you shouldn't have to either. I'll be very clear on that. There will be some questions you're only going to need 5 or 6 seconds to get through them. Okay, so will there be a few questions over co-insurance on this practice test? There will be, and you're going to need a few more minutes to get through those. Can you use your phone on this test? Yes, because it's got a calculator on it. But don't cheat. Nobody Google anything else while you're taking the test.